Hello everyone and welcome to the fourth quarter and full year FY18 earnings conference call of LTTS. I am Pinku from the Investor Relations team. I hope you have had a chance to go through our investor release and financial statements. If not, you can download them from our website, L&T Technology Services.com. This quarter, we have made a few additional disclosures in the investor release, which we hope will provide greater detail on our performance. On today's call, you will hear from Keshav Panda, CEO, Amit Chadha, President, Sales and Business Development, Upendra Bhatte, COO, and P. Ramakrishnan, CFO. The agenda for today's call is as follows. Dr. Panda will provide a brief highlight of our performance and comment on the business outlook. Amit will talk about the demand trends across our verticals and geos and on our deal wins. Bhattaji will comment on the margin outlook going forward, and PR will walk you through the financial statements. We will then open the line for questions. Let me now turn the call over to Dr. Panda.
Thank you, Pinku, and good evening to all of you. We had a very strong quarter as well as strong year, FY18. I'm very pleased to announce that to all of you. At the start of FY18, I have been saying that we are going to go double digit by close the year at 580 million revenue with a growth of 20% year on year. The quarter we closed is $162.4 million US, which is a growth of 34% year on year. So I think both terms, both quarter as well as year, we have done reasonably well. This is when a few years ago, 2009, when I came on board, and when I looked at it, overall total revenue of 50 to 55 million, then we were saying, how do we take it to $1 billion revenue? I think we are able to see the path right now. Overall, the 50 to 60 million in FY19 to 162 million in the quarter is, I think, great achievement. The team has delivered. We always talked about when we started doing it, what should be the differentiator of LTTS. One is engineering heritage we talked about. We also said DNA is our DNA is innovation. And the third point we talked about multi-vertical segment. The technologies can be borrowed from one segment to other segment. I think that has given us good return. The quarter, the whole year of FY18, today if you look at it, we have 240 patents along with the customer, and we are own patents of 83 LTTS patents. So the innovation we talked about, it has created a platform and solution for patent all three together. That is the outcome of innovation. And we have been able to get 48 of top 100 ER&D spenders, companies who are spending, customers spending $1 billion plus. That is a great achievement again. New technologies, we did, new technology investment we did in terms of lab and training people, not only digital, both the smart product and manufacturing areas. We also invested in 32 labs around the world, not only just India, but outside. And that in the area of, embedded artificial intelligence, we did work on NB-IoT, 5G stack, and multiple areas investment of what we did. That also is paying us in a big return. We work extensively on IoT chipset module, which is, I think, today's world, if you go to auto, medical, in any areas, this is so important that how well you can do for end-to-end chip design. That also helped us in a big way. We have revenue. We have 26% revenue we got from digital and new age technologies. Again, almost double the revenue of last year, the digital and new age technologies. When I talk about new age technology, the areas I talked about, NB-IoT, machine learning, or embedded artificial intelligence, 5G, and so on. So this is, again, we are very excited about this growth. One thing we see now on the IoT side, the areas which is the growth we got more and more, if you see, optimized manufacturing operations. There are multiple areas we are working on, and we believe that is going to scale up. That also helped this quarter, and will help in subsequent quarter. Predictive analytics and AMS, for AMS. This is the area, again, understand the manufacturing product, and this has helped us to where we are. The year FY18, HFS recognized us for LTTS for a strong manufacturing and engineering practice, along with over 300 IoT engagement across multiple verticals in multiple geography. That is, again, we are very happy about that. Like every year, the FY18, they also, we are on the leadership zone for 10 verticals, overall leadership zone in product engineering services, in FY18. FY18, we got the prestigious innovation award from CII This is what we, few months ago, we got in FY18. So these are the 3 awards. In addition to that, we also got the award for IoT from HFS report recently, which published. We have been awarded again on the leadership zone. Let me briefly cover our key achievement FY18, which includes acquiring, I did talk about earlier L&T Technology. That has helped us to high-end VLSI and ASIC design. And this is not just for the earlier what we were doing for the telephone. This is beyond telephone, automotive segment, and so on. We are working some of the exciting work we do end-to-end, high-end VLSI and ASIC design. This is again a big differentiator. It helps in FY18. Security, any of the platform we have, a solution we do, security is an important component of that. So we have a strong team in Israel contributing to that security layer. They are working on it. And this is also, is a positive addition for us, both revenue and competency side. Large deals, we did form a team earlier to get large deals, to work on large deals. And multiple aspects of large deals, commercial model, competency requirement, different geography supporting that. That also has helped us in a big way. On margin, Q4 margin is 16.1% we did, which is, growth from Q3 to Q4. We closed FY18 15.5. There are, multiple areas we work on, areas like, the large deals what you got, the more on-site, that has impacted to some extent. But I can tell you, I'm very confident that the growth, few basis point quarter-on-quarter, I see the visibility, and Bhupendra Bhatia is going to talk more details when it comes to him later after my. Then medium and outlook, looking ahead, we see a large customer. See, what's happening today, ER&D spend is increasing now. A lot of customers are willing to do more than what they are doing today. Our top 30 customer revenue has grown, will continue to grow, and it will grow, not only just traditional engineering, design what we are doing it, or manufacturing we are doing it, more growth in new age technologies, I think that is more and more opportunity there. That's the reason I think we are able to see a growth next year. And if you see overall, we did ask many of our customers now, I think top 30 customers about their digital journey. If you see last year to this year, the customers who were on the strategy stage, and they have, some of them have gone to impact and ROI stage in multiple areas in IoT. The phase of, going through the strategy phase to pilot stage to implementation stage to impact and ROI, we see that is moving in the right direction. Our existing customer, we are a party to that as well, their journey. This gives a lot of confidence that digital engineering, new age technology, and what we have been able to do, we'll be able to deliver a top-line growth of 16% at least for the coming year. FY19, we should be able to deliver 16% top-line growth. We also debated and looked at it. I see we have a target for achieving $1 billion in FY21. This $1 billion includes $120 million of M&A, inorganic growth. Organic is going to go to 880 plus 120 million inorganic growth as I see today. To achieve 880 million, we need a 15% CAGR, which we are confident I think we should be able to do that. Now, the 120, as I'm sitting here today, that 120 could come down to 94 million, could take us to $1 billion, or maybe 100 million can take us to this. As I see today, I think this is something we are very, very seriously working out, and we will hit that $1 billion soon. In FY21, we also expect the revenue growth over the next 3 years to be accompanied by the margin improvement from FY18 levels, what we have. Let me now hand over to Amit, who will take us through the vertical geography situation and the future as well. Amit.
Sure. Good evening all, and thanks Dr. Panda and Pinku. I'm going to provide you an outlook and some details on how we see demand across verticals, geos, our deal wins in the quarter, and our deal pipeline. Starting with verticals, as you are aware, we operate in 5 verticals: transportation, telecom and high-tech, process sector, industrial products, and medical devices. Our transportation segment grew 15% annually and 24% in Q4 year-on-year. In line with our strategy to focus on micro verticals, allow me to provide some color. Automotive continues to be on a fast path of growth across US, Europe, and Japan. given increased levels of investments in autonomous driving and passenger assistance systems and higher levels of autonomous driving. Electric vehicles in areas of battery and form factor management, infotainment systems integrating various devices and applications. Additive manufacturing is becoming another clear area of proof of concepts like Dr. Panda spoke about, with some traction in the US. All in all, we see speed to launch rather than cost arbitrage as becoming critical to winning new and sustaining old business for us in this sub-vertical. Trucks, buses, and off-highway equipment is a second sub-vertical, which is showing growth in areas of product variant development, value engineering, remanufacturing, with construction equipment leading the way. In the aerospace segment, we are seeing demand in obsolescence management and testing, and have had some wins in the previous quarters as we have announced, and continue to ramp up incremental wins in air traffic management systems, in-flight entertainment systems, and avionics. The FY19 growth, therefore, for our transportation vertical is expected to continue for us in line with performance in FY18. Moving on to telecom and high-tech, this vertical grew substantially for us in FY18 on the back of large deals we won in media entertainment, semiconductor design development, 5G network development and rollout. We expect continued demand in the semiconductor space driven by more needs in the smart home, healthcare, automotive, artificial intelligence and big data areas. Telecom infra equipment driven again by IoT connectivity, NB-IoT and 5G on the two sides. Consumer electronics, wearables, adaptables, driven by artificial intelligence trends, and media and entertainment-driven deals. We had talked earlier in the year about transactions we signed, and those continue to help us to sign newer deals in the areas of OTT, augmenting set-top boxes, as well as VR applications and home gateway deployment. All in all, we see robust growth continuing in this segment for FY19 and beyond. The third sector, process industry, we have shown modest growth in the area in the first half of FY18, but demand has picked up in the last two quarters, with Q4 itself growing at 16.9% year-on-year. The key trends that we are harnessing here are plant design and upgrades and modification activities driven by MNCs and India Inc. in CPG, chemicals, tire in India and Asia. Second, chemical industry continues to expand upgrade plants in US and Europe, giving us plant redesign opportunities. And oil and gas, this sector has decisively and moved with scale and digitization of assets to improve data calculations of proven reserves, as well as expanding reliability and standardization. We won two large deals recently with Qtr4 and ExxonMobil that we had announced earlier in this calendar year. Both deals and other wins have ramped up already and will start showing results in FY19. We therefore expect that the vertical will grow at a pace faster than FY18 and in line with the growth witnessed in Q4. Moving on to industrial products, we have maintained our market leadership in this area and grown incrementally in building automation, electric drives, power generation. We've got a lot of projects in IoT connectivity and applications, value engineering in FY18. We've also won 2 IBM installations, our own product installations in Asia and Middle East, giving further traction to our product portfolio. We do see spends being conservative, but we see potential for scaling up some of our smaller accounts, and we expect to do better in FY19, targeting double-digit growth. Our last sector, medical devices, we are witnessing a swing in demand because of patient care at home, overall lower cost of healthcare, and decision-making insights of patients as well as hospitals. We see this in the US and Japan, and we expect to continue growth in FY19. From a geo standpoint, we've grown US by 15% in FY18, Europe by 9%, rest of the world by 39%. In terms of demands in the US and Europe, we see traction in new product launches, IoT application development, smart manufacturing like Dr. Panda talked about. In Europe, some of the investments we made in FY18 are starting to pay off, and we expect the growth trend to continue. In case of Japan, because of the Olympics there, we do see additional spend and traction. We've also increased our footprint geographically into Singapore, Australia, and are exploring South Africa and Israel as newer markets. Our deal pipeline, some of our large deals and T30 have continued to be a focus. Some of the wins that you must have seen in the release that we have done for a Japanese OEM, expanding the work in the variant model development involving mechanical, hydraulic, and embedded work. It's a multi-year deal. Exxon Covestro we already talked about. And in the high-tech segment, we have won a 5G-related product development, deployment, and testing contract for a U.S. major, networking major. All in all, if we were to look at our deal pipeline, we do see further closures in automotive, industrial products, process engineering, and process sector, and telecom. Our T30 accounts continue to grow, and you can see year on year, we have two additional clients in the 40 million. We have an additional client in the 40 million bucket and three additional in the 10 million bucket. So overall, to reiterate, the guidance Dr. Panda gave, we are confident of at least 16% organic revenue growth in FY19, and we expect more broad-based growth in transportation, telecom, high-tech, and process, leading the way, and industrial products doing better in FY19 as opposed to FY18. With that, I will hand it over to our Chief Operating Officer, Mr. Bhupender Bhate.
Thank you, Amit, and good evening to all of you. I would like to provide an update on the margin outlook for FY19. Like Dr. Panda mentioned, we have initiated several actions in FY18 to improve our margins. Some of the engagements that we signed in FY18, especially in the transportation and telecom sector, have been on-site heavy. But we have done this with a very clear intention to expand our technology footprint. For example, in the last deal in telecom, it has given us expertise in the video security and analytics. And you all are aware that security is becoming a very important in almost every devices as well as the online platform. And today we are well equipped with this skill. Similarly, in the transportation, we have taken up some engagement which initially are on-site heavy, but that has led us to an entry into autonomous driving. And it has helped us building up the competency in this crucial area. We expect that we increase the traction with the clients and we'll be able to move this engagement to offshore and improve our margins. The second lever that we see is that we are seeing that there is our clients are comfortable in engaging us on a managed service model. With this managed service model, we have a more opportunity to increase our offshore pie. In fact, in one of our recent large deals, the managed service model where the client is also benefited from the consolidation of vendor and by working along with us. The third lever that we have, and the most important lever, is the employee pyramid. In FY19, our fresher intake will be higher than the previous years, and you will start seeing the same. We'll start seeing the same in the hiring numbers from Q1 onward. As we increase the scale with our top clients, we can reduce the average CNB cost using freshers. The fourth important lever that we are exercising is on the bill rate improvement, and this is an ongoing exercise. We have made some good progress in FY18, and we expect this trend to continue. Lastly, our SG&A cost. This particular lever, we expect this to also benefit us because with our top-line growth, we don't expect the same amount of growth with our sales cost, and as a result, we'll get an overall improvement in this area itself. So with these 5 important levers, we do see that we will have a good margin improvement in the coming quarters. Thank you. Over to PR.
Thank you, Mr. Bhate. Good evening to all of you, and thanks for taking this call. You must have gone through the investor fact sheet. I'll try to sum it up and try to convey some of the salient features for the quarter and the year ended 31st March 2018. The rupee revenue, we closed the year with a rupee revenue of 37,471 million for the year with a growth of almost 15.4%. And on a quarter basis, we had a revenue of 10,548 million with a growth of 8.8% quarter on quarter. In dollar terms, we touched 580 million for the year, upwards of the initial guidance, whatever we had provided, with the industry-leading growth of almost 20% for the year. And for the quarter, our revenue was 162.4 million, having a 7.6% Q-on-Q growth. In constant currency terms, for the full year, we grew at 18.2%. Coming to EBITDA, our full year EBITDA margin has been at 15.5%. As you may be aware, for the first 3 quarters, we were having a EBITDA margin of almost 15.3%, same. And during Q4, our margin crossed 16%, thereby to touch 15.5% for the full year. The PAT, or the net income for the year, has been at rupees 5060 million, which is almost higher by 19%. Coming to the P&L statement in detail, just to give a perspective, I talked about the EBITDA margin for the year at 15.5% and for the quarter at 16.1%. As you may observe, from the segment operating profit and also from the other fact sheets, whatever we have talked about, the margin improvement has been attributed to a sale of IP in one of the segments under Telecom High-Tech, partly offset by an increase in variable pay for the delivery and for the entire people in the organization during Q4. And secondly, margins also offset by a lower margin in the transportation segment. As Bhateji talked about, that over the period last year, we have been consciously investing as in these engagements as an investment, and we believe that these margins will improve over the next year. Now, coming to some specific points which I want to highlight on the P&L. I talked about the EBITDA margin. After that, you will have one line item talks about change in contingent consideration, which is reflected in the Q4 numbers of 55 million rupees. This relates to the changes in the fair value of the conditional payout, which is facilitated under the SPA, whatever we executed for acquiring Essentia. With this change of 55, we have closed out the conditional payouts under the Essentia SPA, so we will not get anything further on this regard. Depreciation and amortization, there has been an increase of almost, there has been an increase during Q4. We have kept a number of 452 million rupees. This is partly on account of two elements. One is we had a one-time obsolescence charge of certain software to almost 550 million rupees. And the balance increase is attributed to we have changed our accounting estimate with regards to customer key contracts, whichever is attributed by pursuant of acquisitions. So earlier we had a policy of expensing or amortizing them over a period of 7 years. We have changed it to 4 years in line with underlying assumptions. Coming to the income tax, our provision for tax for the year stood up to net inclusive of deferred tax is at 1712 million rupees as against 1542 million rupees for the previous year. Having said that, our income tax provision for the quarter at 344 million is dropped when you compare with the previous quarter. That is primarily in account of creation of deferred tax assets on account of the notes, whatever we have written in the fact sheet. Coming to a breakup of other income, our other income, total other income has for the year was at 1910 million rupees. And for Q4, it was at 747 million rupees. The 1910 million rupees for the other income for the full year can be broadly taken as foreign exchange gains and loss contributing to 1147 million rupees and the others at 693 million rupees. A major part of the others comprises of some part of licenses which we had sold during Q3 and some of the licenses getting valued during Q4. These are export licenses. Coming to overall balance sheet, from a total assets perspective, today LTTS total assets is at 27051 million rupees as compared to previous year of 22329 million rupees. The increase of almost 500 crores can be attributed to the intangible assets which arose because of acquisition of Essentia and increase in account receivable majorly for the balance, primarily driven by higher revenues. From a cash flow perspective, our free cash flow for the year has been reported or is at 3619 million rupees as against 3425 million rupees. we believe an improvement in DSO and a better management on, overall other assets will ensure that we have a better cash flow in the subsequent year. Coming to the other operational metrics, some of that my colleague Amit Chadha had covered, but nevertheless, for the sake of clarity, our transportation vertical continues to remain our vertical, which having the major size of our revenues, almost 32% of our revenues accrued in transportation, followed by industrial products at 23%. Telecom high-tech has seen a huge jump in the current year. Its share in the total revenue stack is almost 26%, plant engineering at 13%, and medical devices at 7%. In terms of revenue by geography, as is always been that a major part of the revenues continues to accrue from North America, that is roughly around 60%, and Europe contributes to 17%. We have seen an uptick in the revenues from India, partly driven by one or two engagements, and the rest of the world at 11.7%. The revenue by project type, we have been always maintaining, or traditionally our revenue by project type always been fixed price to T&M at 35-65. I think that continues. Dr. Panda did talk about our key accounts in terms of and also Amit Chadha covered that. So just to tell you that during the current year, we have moved 2 clients into the $40 million bucket, and similarly 3 clients, moving to $30 million bucket, which enforces our continued emphasis on the T30 strategy. In terms of client contribution to revenue, the top 5 clients, they are at around 27% as against 23%, and that's primarily because of the earlier statement which I made that the top 40 million clients and the 30 million clients getting added up there. In terms of employee statistics, during the quarter we had around 350 odd additions, and as of March, our headcount is around 12,300. So, and the board today declared a final dividend of rupees 12 per equity share, thereby making the aggregate at 16 for the full year. We had an interim dividend of rupees 4 per share. So the dividend payout has been increased or shown to 40% to only reinforce that if we have cash which is beyond the immediate requirements, this is what we expect to give it to the stakeholders. With this, I have tried to summarize the performance for the company for the year and for the quarter, and we take a pause and we are free to take questions.
Thank you. Ladies and gentlemen, we will now begin with the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Ankur Rudra from CLSA. Please go ahead.
Thanks. Congratulations on a very good set of numbers. Good to see another very strong beat. I have a question on the guidance. Your exit rate from FY18, where performance was very strong, is about 12%. The guidance appears to imply something like a 1.6% CQGR for the next 4 quarters. This seems to be at odds with the very strong commentary, where I think almost every vertical you are talking about stronger growth next year. So I'm just trying to understand this a bit better. Are you baking in some kind of a decline in maybe some of the on-site-based projects from last year, or are you just being conservative?
Yeah, I think I said 16% growth, Ankur. This is Dr. Panda here. 16% growth, revenue growth of FY18 to FY19. That is the minimum what I talked about. And this is always when you do a large deals, the on-site we are going to reduce as well. Because I think if you are to get a margin improvement, the percentage of on-site offshore also is an important parameter. We are going to do that. All combined together, the order booking we have and what we are sure about right now, what I see, 16% growth top line, which is going to happen. See, earlier I was talking about double-digit growth, and we want to be more specific this time, making sure that that visibility we have.
Okay, because the commentary also was that the momentum should stay. So this probably, we would say this is the lower end of your guidance. You should do something stronger than this for sure.
Maybe next quarter we'll talk about, if this beyond this, so we'll have to go. All the time, I think we were saying double digit could be any number. So we said, can you be a little more specific? So we said 16%, what I see today. Maybe next quarter when we talk about, maybe we will have a better number than this.
Sure, sounds good. And also helpful to see the 3-year outlook as well. Just a question on the Essentia transaction. Could you elaborate on the nature of this transaction, the assets that are being sold, and how this impacts the remaining part of the business that stays with you?
Okay, Ankur, this is PR. We'll just summarize. I think we have covered that in the fact sheet. So we acquired Essentia on the 1st of June 2017. Okay, and as part of the engagement with one of its very important clients, we had a transaction which happened in the Q4 where we sold an IP and also transferred some of the people. The milestone which primarily related to the sale of IP happened in Q4, and thereby Essentia got a money of $3.5 million, out of which 2.9 has been allocated towards the value of IP shown on the revenue, and the balance 0.6 million has been taken other income. In the current quarter, that is Q1 of FY19, as part of the engagement, as part of that transaction with the key client, we have received already $12 million from that client, and that will be shown or reflected in the current year under other income because it primarily relates to waiver of non-compete and other stuff relating to transfer of resources. So with this, what we have done, we have taken this, as you may be aware, when we acquired Essentia, we had disclosed that there was an upfront consideration of $15 million which we paid to acquire 100% of the equity, and there was a conditional payout which over a period of 3 years. Now, because of this, what we have done, we have covered the conditional payout and we have foreclosed the SPA itself, and that is why you will find a one-time, separate line item in the P&L which talks about a 55 million rupees charge, which is the change in the fair value of that conditional payout. So that has been also closed.
No, I understand the financial details. You've been quite helpful in the disclosure there. I was trying to understand qualitatively what are the nature of resources you're selling out, and why sell out something so soon after buying such an attractive acquisition?
No, actually, there is one customer where we transfer some of the resources to a specific 14 number of employees. Essentia had 127 employees, right? Out of that 14 employees we transferred there. The reason we transport that, the company where we transport, I think they were getting more into engineering, and they did not have too many people in engineering and technology area as well. We transport them. This help us to grow our business in those customers. The customer where we transport, our run rate has increased now, quarter on quarter is increasing. Maybe we'll close 10 million this year, itself revenue this year. The potential for the customer, we did a calculation about the long-term plan for doing this, and we believe that these are the following names. I think Facebook, Google, Apple, and Microsoft and Amazon and these guys, the investment and the areas where they are going through, and as an engineering technology company, it is important that they should be our customer moving forward. So looking at overall point of view, these resources, the engineers who have gone there, they are, the lead in these different groups of project group of engineering there, and that is helping us to scale up. We strongly believe the relations we have, and they know what L&T Technology Services can do along with Essentia together, and that is already paying us dividend for doing this. So business point of view, it's a great opportunity for us. And again, the work we are doing for, whatever semiconductor area which we are working on, chip design, ASIC design, and high-end work what we are doing it, we had 127 people. Out of that, 14 people are gone. So I think it's not a big impact in terms of, what we have, really got. I'm very excited about Essentia, M&A. Essentia, I think there's a great people, actually. The quality of engineers are very high. And we still have the people, we continue to deliver, and the revenue point of view still continue to do well. So Essentia, our focus on Essentia is still there, will continue to be there. They are a big component of our strategy and big component of our business. And, only thing, in addition to Essentia, their customers we have, and we got into something else where I think there's a great opportunity for our growth.
I understand. Appreciate the color. Thank you and best of luck.
Thank you.
Thank you. We take the next question from the line of Pankaj Kapoor from JM Financial. Please go ahead.
Yeah, congratulations on a good quarter. And my first question is on the guidance. Do you also, like on the revenue side, do you also have a similar target margin band? And if you could share that.
You know, Pankaj, maybe I think next quarter when we come back, only thing I said is quarter on quarter, few basis points we are going to increase. Maybe a little more visibility. We'll have like top line guidance. Last year, we were only saying double digit. We have some clarity on top line. Bottom line, there are various levers what we, initiative we have taken in FY17 and 18. That is going to pay us in FY19. So we are only saying that few basis point quarter on quarter increase will so. And exact number maybe next year by this next quarter, we'll have more clarity and or 1 or 2 quarters from today, we'll be able to give you absolute number in terms of what that's going to be.
Sure, sir. And so on the cost side, do we have the wage hike following the regular cycle this year? So should we expect something coming in the first quarter?
We are looking at various models to do that. And this is something which I would not right now, don't see that. But, we don't even, we don't know how this is going to be. We'll look at that. But one thing I can tell you, though, very clearly, what we have done is overall, I don't see too much impact on this. And one point I will tell you that the model we have come up with, just 1 second. Yeah, Pankaj, this is on the Q1, there is no impact. There is no salary increase. Q2 onwards, we are working out Q2 onwards, the impact, what is going to happen. But we have come with an innovative model. I think the employees, like, the earlier business model of adding number of employees, increasing revenue, those days have gone. We similarly, employees earning capability, capacity should depend on the performance of the employees or performance of the group. So I think the impact, the way it was before and now, I think there's a difference. That's the reason we are working out Q1. We'll have a lot more clarity and we'll be able to tell you a little more on that time.
Sure, sir. Sure. And just lastly, one clarification on the SNCR transaction. So will that have any revenue impact for us in terms of any revenue loss? Was this sale that we have done of the IP, was that IP generating any revenue over the last few quarters?
No, not really. There won't be major revenue impact because of this deal. So we did work out that. There is no top line growth, impact. And on this license earning revenue, that was not the case. Because this is after we acquired Essentia, LTTS and Essentia together build on that, this is the IP which we transport, right? So this is not just Essentia, this is Essentia and the L&TTS engineers together, they created, given a safe to the IP which we have been able to sell it. So there is no impact, whatever we are getting in the past quarters, and is that impact future? No, there is no impact.
Sure. And Pia, just 2 quick questions on the other income side. Any outlook you can share on the SEIS income in the FY19? And second, on the tax rate that you expect for the FY19, yeah.
So, okay, let me tell like this. In the next year, that is 18-19, we have hedge contracts which are around 71 on the dollar rupee side. So as you may be aware, if the dollar rupee is at 65, the other income will be higher. If the dollar rupee at 68, so obviously that part of the depreciation will obviously positively impact the EBITDA for the current year. To that extent, the other income portion will obviously come down. As far as the SEIS is concerned, it's slightly too early because we will be filing the claim for 17-18 maybe after Q1 is over. So it would be too early to say when the licenses, will be procured. But I believe sometime maybe end of Q2 or early Q3.
Sure. And on the tax rate, if you can give a color on that.
So tax rate, because of this Q4, the adjustment which I talked about in terms of credits under provision for deferred tax, for which we have put an explanation in the analyst fact sheet. Otherwise, in the current year, our tax rates will come back to possibly around anywhere between 26.5 to 27.5.
Got it. Thank you and all the best.
18-19, huh?
Yeah, sure. All the best. Thanks.
Thank you.
Thank you. Next question is from the line of Nikunj Bandora from Edelweiss. Please go ahead.
Hello. Dr. Panda?
Hi.
Hi, Dr. Panda. Good evening. Congratulations on good set of numbers. Sandeep Agarwal from Edelweiss. Dr. Panda, I have two questions. First, on the revenue side. So I just wanted to understand if you see all the global agencies are predicting a very strong outlook for the whole engineering space where we have specialization, and in fact, some of the agencies are quoting that the industry growth rate will be maybe double of the IT services growth rate. And we being a specialist in this area, our growth rate probably would be higher than the industry rate by a significant margin. So my question is that is the 16% which you are guiding, and I appreciate the fact that you people have come out with a very specific number. Does this build a very, very significant amount of under-guidance or conservatism in your number one? Number two, which are the areas where you are seeing very significant change in the way deals are getting awarded or deals are coming? Is there any significant change in any segment which you are seeing?
If you see engineering, outsourced to India, other than captive, the CAGR is around 12.5%. So I think opportunity point of view, 16% what I'm saying, am I conservative on that? This time I would not say beyond this. Maybe I think we'll have more visibility in quarter one. And if you recall last year, quarter one, we were talking about only double digit, and this question was asked whether we can do 12% or 14% or 15%. Now we achieved 20%. So I think opportunity, only thing I can tell you is opportunity is there, and these our top customers have more demand, they lift more and more. And there is no reason with the investment in new technology and digital work we are in the leadership zone with all this together engineering DNA we have. There is no reason why we can't do better than anybody else. If you see IT industry, whatever guidance they have given, you see NASCOM guidance what they have given, I think this 16 is a quite reasonable growth in my view at this time. But I think we are not leaving, if you have to hit $1 billion, we need to do better every year on year so that we can meet that. And growth point of view, whether which area is going to grow, which segment is going to grow, we always look at it which segment is, today, if you see the ER&D spend addressable market, there are two areas which is high. One is telecom, semiconductor, consumer electronics, and the second one is automotive segment. So where the ER&D spend is high. But we look at more and more, but balancing out overall together, I am not even talking about today, one business segment. I'm only talking about horizontal. Which technology which I have, which is going to grow, which is going to add to multiple customers. So I think that's where we look at it. And one area which our biggest differentiator is the plant engineering. If you see in the past plant engineering, we have gone through the difficult, growth area. Now plant engineering is doing very, very well. It's grown this year. It will continue to grow. The order booking is reasonably good. So one point I'll tell you, when you talk about digital, a lot of report about digital twin, I saw a nice report, I think TCS report I saw. But we have been working on digital twin for a long time. On the digital side, whether digital smart product design or smart manufacturing design, we have multiple platforms, we have multiple solutions. Now, we did a survey. We went to our top 30 customers, asked them, where are they on the digital side? If you see today, they have moved from strategic stage to more on the impact and ROI stage. Now, the percentage of strategy stage was there in FY17. FY18, they are more and more, and the opportunities are more in optimized manufacturing operations, agility, digital, predictive analytics for AMS, and so on. So I think these areas combined with this together, the top 30 customers, the assets what we have created, that is going to drive the growth in every segment. I'm not even looking at segment. Plant engineering is going to do well. Off-highway, if you see, off-highway segment was slow, and that opened up very well. They want to use new technology. What automotive does, off-highway would like to more and more follow what automotive segment does. So I think the way market is not just one segment to other segment, what technology we have which we can take from one to other, that's the biggest thing, in the future.
So thanks for very detailed answer, Dr. Panda, once again, and thanks for giving me the opportunity to ask a question, and best of luck for the future.
Thank you. Thank you.
Thank you. We take the next question from the line of Mayank Babla from Dalal & Broacha. Please go ahead.
Good evening, sir. Congratulations on a great set of numbers. I just had one query. It was regarding the 259 million rupees, the amortization charge. So I just wanted to understand the accounting entry as far as this customer contract is concerned, because I wasn't understanding it. Is it capitalized before, or how? Can you explain it to me, please?
Yeah, this is PR. So it is like this. See, when you do an acquisition, especially of a services company, obviously you acquire certain assets and you pay some consideration. The excess of the consideration paid over the fair value of the assets is taken as into two parts. One is, what are the other intangible assets by way of that acquisition which you are acquiring? So in most of the cases in services companies, some part of this excess consideration which is paid is allocated to what we call that the company the acquired company has some key clients, and to which you will have stickiness of revenues. So some value is attributed to that, and any other residual value is finally taken as goodwill. Now, historically, or ever since as LTTS, we were amortizing that portion which has been allocated for key client accounts over a period of 7 years. So in the current year, as part of a change in accounting estimate, instead of expensing or amortizing it over 7 years, we have taken it over a 4-year period.
Okay, got it, sir. Thank you so much.
Thank you. We take the next question from the line of Abhishek from Equirus Securities. Please go ahead.
Hi, thanks for taking my question. This could be a repeat on the Essentia transaction, but could you help us understand what is the value of the Essentia today? Because you bought Essentia, I think, for $27 million, and you are selling 14 or 16 employees, if I heard it right, and an IP transaction with getting around $16 million. So how should we look at the value of Essentia today? And the second question is, what happens to the founders of Essentia? Where are they moving along with this transaction?
Okay. First and foremost, I wish to tell you, I think Dr. Panda covered that in great detail, is that in no way this particular transaction has any sort of an immediate or any adverse impact on the company. First and foremost, Essentia was acquired in the 1st of June, and now, as far as ASIC and VLSI practice is concerned, that entire business, we are in the process of getting it completely integrated with that of LTTS. And that was one of the reasons that we completely foreclosed with this one-off transaction. We foreclosed the SPA itself. Secondly, there are two other founders which are part of the Essentia driving the integration process into a next stage. Thirdly, we are also actively pursuing opportunities in terms of further beefing up, competencies in this particular segment, but it's too premature for us to comment anything on a clear basis. So, Dr. Panda, would you add something?
Yeah, Abhishek, I think it's difficult to answer you about what is the value of Essentia. Essentia is no more independent now. There are a lot of things we do, like we talk about the IP. LTTS and Essentia together have been working on this to, monetize that, right? So I think today, as you rightly said, 27 million is the valuation of what we did. Part we have paid, and part on the earning which was there. We closed the SPA now. And this is the next course of action. Is these people, the two of the partners, they're still, the CEO is there, the next person is there. So they're still part of the Essentia and LTTS. We are looking at long-term point of view. As you know, semiconductor is a big practice for us as well, what they do. But they do the higher end of VLSI ASIC design, and then, the bottom portion of it, what we have been doing it. Now, the value we can get, and again, the hardware part of that, there is a team in Israel. So what we are trying to do is now how to integrate the Israel team to the San Jose team to the Bangalore team together, integrate into a single team, which can not only do that, in a semiconductor area, they can also go beyond the semiconductor, automotive, medical. There are a couple of new wins we had, and which we have been successful in doing that.
Thank you for taking my question.
Thank you.
Thank you. We take the next question from the line of Ravi Menon from Elara Securities. Please go ahead.
Thank you, and congratulations to management team on another fantastic quarter. And thank you for the guidance too on the clarity of that. Just on the guidance.
Excuse me, sir, I'm so sorry to interrupt, but requesting you to please use a handset mode so we can hear you better.
I'm on a handset. Let me just try speaking up a little bit more.
Sure, thank you.
Hello. Yeah, so I was saying that, congratulations to the management team on a really good quarter again, and thank you for the great clarity in the guidance. But, if I heard the comments correctly, it seems like, that whatever was the drag, or I would say the slightly lagging parts of the business, that's also poised to kick into gear in FY19. The process industry, we were talking about a very strong order book over there. So, Dr. Panda, I know that communications, you would not have the benefit of a large deal that you did over this year, but still it seems like, your guidance does seem more conservative, given that there are really no drags in the business. Or are there any parts where you expect the business to be slightly softer?
I think this is not correct to say that we are not working on large deals this year, FY19. There is a team of people working on large deals in different areas. This is a process, continuous process. This will continue to be there. And the only thing is which segment the large deal is coming from, which segment, and how much is going to add. When we are drawing a plan for $1 billion, which we said by we're hitting by FY21, next year with 16% or beyond whatever the number we are going to deliver, this is also we have to look at FY20, FY21, so to hit that number. So I think large deals focus is continued to be there. We'll do much more aggressively than what you have done. And, the commercial model, what we learned from the large deals we did so far, the lessons learned, we'll do a better job of doing it subsequent years, deals we are going to do. And I think the overall in the right track. I would ask Amit to add.
Sure. So, Ravi, number one, Dr. Panda, like he has said a couple of times now on this call, we had said double digit, and then we've given 16% at least organic this year. If you look at it, large deals, we started talking about large deals since January. And since then, quarter on quarter, we have reported to the market on the deals that we have won. And they've been broad-based, not just telecom, high-tech, but in automotive as well as in the areas of plant engineering. Having said that, there's a clear focus and pursuit in the large deal area. There's and value creation for the client and ourselves. So there is middle-of-life support, NPD factory models. There is digital IoT, both product and plant. There's vendor consolidation deals and upscaling and managed services deals. So we've actually gone a step deeper than just saying large deals to breaking it up into 4 categories internally and working it at a pace that will help us in this year.
Great. Thank you for the color. Secondly, Dr. Panda, you talked about how you're still looking at a horizontal-based approach, and you've still not locked, and you talked about how, you want to take that and use the same capability across multiple verticals. That's part of your strategy. Can you give us an example or a couple of examples for that?
I think I always talked about the one which is the last few quarters we've been talking about, the screwdriver, we did. Okay, the screwdriver design. And if you see how do you take, from learning from telecom and implement that in screwdriver. And then you look at it, we are working on, which is called electric vehicle or hybrid vehicle in automotive, taking DC-DC converter and, doing the DC-DC converter, stackable inverter, which you did industrial, we have taken that to automotive, right? And now look, there is a concept we did on energy management we did at the beginning, that we have taken to the smart campus management. It includes a lot more technology than what we did before. And not only we did that, we've been able to successfully selling in Australia, we sold in Israel, we are right now discussing with a customer in Singapore. So I think this is not possible to say that's one vertical if you do. Vertical domain is essential. I would say 25% should be vertical domain. 75% we should be on the technology and in line with the verticals. I think if this is the integration possible, I think which we have demonstrated this year, we believe we'll continue to do that for coming years as well.
Great. Thank you, sir, and best of luck.
Thank you. We take the next question from the line of Shamal Durve from Phillip Capital. Please go ahead.
Yeah, thanks, and congrats on a very good set of numbers. So my question is regarding the aspiration or guidance you have given for FY21. So in your opening remarks, you have said that out of this $1 billion of revenue, you are targeting around 120 from inorganic route and 880 from organic route. So regarding this 120, are we whether we have finalized any vertical or geographies where we want to do any acquisition, or whether it would be acquiring new clients? What would be our strategy for the acquisition?
I think we are not going to get a business segment. We'll question whatever we are going to do. This is on technology driven, mostly on technology driven. If you see around the world, there are not too many companies out there, more than 50 million in this segment. So when we acquire a company, we are looking at either should be customer specific, a customer where that particular white space, we need to have that space to get into double the revenue with the customer or revenue growth. So we buy those type of companies. Now, today I'm saying if a 15% CAGR, we grow from today to FY21, we go to 880 million and 120 million. And next quarter, when I come back and say maybe 120 you don't need, we do 100 million. But trust me, there are not too many companies if you want to get, these are all technology companies, not too many technology companies there in the world who are, I think who are at the more than 50 million. So I think we'll do multiple M&A. From this year, I think we are very close to doing one. Hopefully, we'll do that next quarter. We'll announce that. We are very close to closing one. And at the same time, we have a team of 7 people working on looking at M&A hunting. See, white spaces we do every year. When you do a strategy, what are the gap we have in the company and how that gap we can fill it up. In that gap, we are going to fill up hiring people or we are going to acquire companies, right? So that is given to the M&A team with the business leaders, whether vertical or horizontal technology leaders. They work with them and go through the process. Then we, if an opportunity we believe that's important, we take it forward. As far as geography, I think we are open to wherever we do a M&A, we can manage workforce, then we are open to that. If the geography where we acquire a company, there are a lot of, the employee-related issues, union-related issues, we are a little careful about acquiring a company where we cannot manage. We can acquire a company, announce and celebrate, but later on, it could be a dragging factor for us. So we don't do that. So every time, it could be anywhere. It is not necessarily one geography or other, but we always look at it, how do we manage it, how do we integrate it before we acquire a company.
Okay. And just a small clarification. So this 16% guidance you are giving for FY19, it is organic growth guidance, correct?
That is correct.
Yeah. Okay. Thank you. And best of luck for FY19.
Thank you.
Thank you. We take the next question from the line of Apurva Prasad from HDFC Securities. Please go ahead.
Hi, thanks for taking my question and congrats on a strong quarter. So my question is on the margins. You talked about the levers there, but how should we look at it, more directionally? I mean, can we see that going to FY17 sort of levels in the next couple of years?
Oh, yeah, of course. I think we are seeing few basis point improvement quarter on quarter, and we'll have much more. I think we are not keeping quite, not looking at every lever available in engineering. See, I think utilization, we have more or less, I think, come close. There are multiple levers available for us to get into this. So only thing I can tell you is few basis point quarter on quarter, we are committing that now. We'll have more visibility on what level we are going to FY17 level, FY16 level, or beyond that, I think we'll have more clarity in a quarter or two.
Sure. And Pierre, if you can just give some idea in terms of how should we look at the depreciation and amortization line item going forward?
You can take around roughly around 20 crore per quarter.
Okay. Great. Thanks and all the best.
Thank you. We take the next question from the line of Achal Fate from Wealth Managers. Please go ahead.
Hi, sir. Congratulations for a good set of numbers. My first question was if we could have a breakup of the other income for the current quarter.
I think it is there in the fact sheet if you can, but we have 376 million rupees has accrued on account of foreign exchange, and a major part of others comprises of the value of licenses which we secured during the quarter for the year ended 31st March 17.
Sir, on the Essentia transaction, so like the cost of acquisition included a payment of 12 million over the next 4 years, and now like what I read is there will be no further consideration payable to the sellers of Essentia. So
exactly
a bit like at the cost of repetition, if you can just give a clarity on why exactly this will happen, and secondly, does it also mean that $12 million will be included in other income in the next quarter? Like
yeah, that's what I have communicated, that what has come will be recorded as an income in this current quarter, 30th June.
Okay. And like the current 15 million payment done to the sellers of Essentia is the only payment that will be made, no further payment to be made?
And that has already been made. No, 15 million was the outflow from LTTS when we acquired the company.
Right.
And there are no further outflows.
Okay. Okay, sir. Thank you. That's all from
me.
Thank you. Well, ladies and gentlemen, that was the last question. I would now like to hand the conference over to Mr. Pinku Pappan, Head of Investor Relations, for closing comments. Over to you.
Thank you all for joining us on this call today. We hope we have been able to answer most of your questions. If you have any queries, feel free to reach out to me and I will help you in them. Wish you a good day. Thank you.
Thank you.
Thank you.